Hello, good evening, everybody. One more year, here we find ourselves to talk about the past and the future and to tell you about what we've done. Our goal is to start now at 6 and finish around 8:30, and we'll try and answer all questions that we receive as far as we possibly can, but our goal is to have all questions answered. So you can use your cards. There's an application. You can actually vote for questions that have already been asked, so that we don't formulate the same question over and over again. So the approach will be the same as we normally follow. We are now going to talk about Cobas and our key figures. We're going to talk about the funds in general terms to get a general perspective on how they stand and our perspective on them. We are going to talk about the portfolios, 2 investment cases in particular. We're going to hear about oil tankers and here. That's going to be explained by Ivan. And I imagine that most of you connected to the streaming and those of you present here are most interested in knowing about how to close the valuation gap. And indeed, it's obvious that when we have a portfolio at per 6, something's going on in the market, and the market is at per 15, and our portfolio is at per 6. We imagine that has to be closed. So we don't know when that's going to happen, but we'll try to give you some keys as to when, or how rather, we would close that. And that would be the latest part of our presentation. And we encourage you to keep on being patient so that we finally see that happen. And then we'll have, of course, room for a Q&A. Let's go over the figures. This year we have 2 million approximately under management, assets under management. We have, of course, funds in Luxembourg, which are clones of what we have in Spain. We have cloned, in a way, the large companies in Luxembourg, and we also have pension funds according to the legislation of the Basque Country, EPSVs. We have 28,500 new investors that joined us last year. Some of them have been luckier than some of us because they have entered at better prices, but we still have the trust of the new investors and the old ones, because as you see, we have 15 million euros of net inflows, and this is something that we are greatly satisfied of, given the circumstances that the funds have undergone in the last few years and the circumstances of the market in general, with outflows of cash in almost all investment companies. And of course, we do value investment, and it's been damaged quite seriously in the past few years. So we need to be satisfied with these figures. But before talking about the different funds, I would like to go over the different things that we do, because sometimes there's a bit of confusion, so it's better for us to explain what we do ourselves, and in particular what we do in each of these areas. We have a family company, which is Santa Compa. It's owned by myself and my wife, and Cobas Asset Management and Cobas Pensiones penned from Santa Compa, and it's the essence of our work. Actually, I devote 99% of my time to Cobas Asset Management and Cobas Pensiones. I would like to devote more time to everything else that I'm about to mention, but unfortunately there isn't much more than we can do. And indeed, managing a fund demands complete and total dedication. So 3 years ago, when we started to work in this, we decided that 15% of our revenue was going to be invested in non-profit activities, or at least not having profit as the main goal. And we are moving along those lines. We have also stakes in other companies. We are supporting other fund companies that do things that we like. For instance, Palm Fiber with Peter Smith, who used to work with us, and we have an agreement to work together. And also we support Equam as far as we possibly can. It's a wonderful management company, asset management company. We have also released an impact investment fund where profit is not the main goal. It is a goal indeed, but it's not the main goal. It needs to be also balanced out with other social targets too. And further to the right, we have have Value School, which is a community of more than 150,000 people. What we try and do there is to disseminate education so that people can invest well. Everybody interested can have access to it, and it encompasses people who have no economic knowledge whatsoever to actually professionals in the subject matter. And some of the courses that have been delivered have been followed by the members of our team. So this gives you an idea of the broad spectrum that we cover. And we have actually released a program that's called Value Kids, and it travels around the schools of Spain, fostering education on economic aspects. And of course, this is also a non-profit activity so that we can raise awareness on the impact of investment. And in Cobas, we have a purely financial target, but if you move to the right along the x-axis, you see that we become a bit more social. And when we, of course, enter Cobas, the field of Cobas, we cannot say that we are not going to be doing things that are reasonable and morally correct. We need to say that we are going to obtain profitability for our funds. Our commitment is clear. But when we move towards the right, this narrative changes a little bit, and there's many other things that we factor in strongly. So as we said, 15% of our revenue is dedicated to this, and the shareholders of Cobas invest part of its income in this type of activities. I insist on this because some people may think that I personally devote time to these things. And I say, unfortunately, I cannot devote time to these things because I would love to do it, but until I retire, I won't be able to, because our work at Cobas is something that takes up our whole day. We're working for Cobas full-time. Performance of our funds. Well, profitability has been reasonable, but we're not even close to recovering everything that we should have recovered. And actually, in the month of January, we've lost a substantial part of this. So we have a long road ahead of us, and we have a lot to do in Cobas International and Cobas Iberia. But we are nonetheless in the right track, slowly but surely. Let's do a portfolio review. Talking about the international portfolio, at least the top line, which is the one that shows our work, has been growing upwards, and the value of the fund has increased this year. Let us remember that last year the value of the fund fell from our perspective. And we will see some examples that are quite obvious to illustrate this, but this is our target value, our objective value. And because of the decrease in valuation of Aritza, our value fell. But this year we will not have one-offs of this kind, and normally we will see this line go upwards, and this is what we expect to see in upcoming years. And as we will share now, this has been the Spanish case. There is great potential here. We will see some examples to illustrate that we are not just coming up with this potential. It's not a delusion of us, but rather it's because these companies have great potential. Upside potential is 126%, perhaps a bit higher today. The ROCE, it's 26%. We have very good returns on our capital. These are companies that make a lot of money based on the capital that they invest. They invest 100 and they earn 26, and 25% of our portfolio is invested in infrastructures and the maritime sector, which are businesses where they have very low profitability over capital. It's about 8%. So these are businesses that are extraordinarily good, and we are listed at per 6.6, which is amazing. Actually, when I started working in this a few years ago, it was amazing to find these things. And in the Financial Times, they were asking me whether we thought that the market was efficient. And I said, well, listen, I don't know. I think we'll sit at our desks every day and we find things that are very cost effective. And at some points, we have been purchasing at 7.5 times, and we are at 6.6 right now. But we're seeing price ratios right now that are very attractive. And the benchmark, it's the Morgan Stanley Global, 14 times, or Standard & Poor's is at 18. So we have a very big discount compared to the price of to the valuations that we see in the market. In Spain, we have a return on capital of 25% with great potential, and As you see, the green line, the top line, continues to go up. We continue to buy companies, and companies continue to grow, as we will explain later on. We are at PE8 compared to the Spanish market, which is at 13%. Therefore, basically, both are exactly as attractive, perhaps not so much in Spain, but we are very well acquainted with the companies after all this year. So after having reviewed these companies in a very broad perspective, the question is, but how is it possible? How do we find ourselves in the situation with a portfolio at 6.6 when the market is at 13% and rates are very low and people don't find anywhere to invest their savings because they don't get any profitability from their investment? How is it possible? Well, in short, what happens is what's always happened, is that we have been in a bullish market for many years, and the market is not strictly rational, or it's at least losing part of its rationality. And I've always said this, and once again, we see this materialize here. For us, the worst moment in investment is the end of bullish cycles, because in the end, there's a natural trend to create a snowball effect, to invest in the things that are rendering good performance. And people think, okay, if it worked well in the past, why won't I do the same this time? Well, it's just human nature. So in reality, this is what's happening. And we are just going to share a couple of graphs to add more nuances to everything that I mentioned. And we're going to see how value investments compared to increase. We do value investment. And oversimplifying, what is it about? Well, it's about buying at PE 6 or 7 when the market is at PE 15. So it's obvious that cheaper companies will perform better over time. So we have selected this graph. It's very interesting. It starts in 1953. This was created by Robartum, by research affiliates, and it covers a great amount of years. So what we wanted to see is to have a perspective on how a dollar invested in a value portfolio in the United States performed 9 times better than a dollar invested in growing companies. And this is logical. If you are investing at 6 or 7 times profit, it's much better than if you're investing at 15 times profit. But what has happened is that in the last few years, this has ceased to be real. This has ceased to be true. Actually, the last point was the technological bubble in the year 2000. It means that the line started dropping and growing companies started to perform better. And of course, these things correct themselves because ultimately more affordable things continue to be attractive. But what has happened in the last 13 years precisely? What has happened is that 9 times better, which is the performance that value investment had, has become 6.6. I mean, value investment has performed worse than growth investment in the last few years, especially focusing on the last 3. And as you can see, once again, we see a sharp drop in those 3 years. And this is what's happening in the markets. So perhaps the question that we could ask ourselves is whether it would make sense to buy cheap. Do we have to buy expensive? This is what everyone's doing in the world, right? Everybody's buying expensive things. Well, it's not the narrative that we should apply, but it's a fair question. Rob Arnold and his team, who are very wise, they have conducted an analysis as to whether in the last 13 years, value companies compared to growth companies have had worse return on capital, or if there's been an increase in the gap. And the answer is no. They continue to have the same ROE, a bit below growth companies, but the differential continues to be better, to be adequate, which is 2 points. So there is no reason to think that value purchasing is no longer logical. It may not be trendy anymore, but it is not true that it is no longer logical. So before going on to explain why this is the case, we would like to illustrate this in a different manner. And by the way, this is something that we also explained in our newsletter of in June, which is the value company compared to growth companies are more affordable than ever. Not even in 2000 were they so affordable. And by the way, value investors suffered a lot, but then value companies weren't as affordable back then as they are now. And we find ourselves in a unique opportunity. This is a unique opportunity, but we are also suffering in a very unique manner. Why is this happening? Well, here we would like to show a very interesting slide comparing what happened in the year 2000 and what's happening now. We can see that in the year 98 and 99, the gray line show net profit of the 5 top companies in Standard & Poor's, and the green line is the capitalization, the market cap of those companies. So making 8% of what Standard & Poor's made, they went on to be at 16% of Standard & Poor's. That's to say, the valuation increased much more than the revenue. Why? Because since the year 82 to the years 2000, we had experienced spectacular growth in the market, in the financial markets. It was a very bullish market, and this exploded in a way, using technology as an excuse, and some of the companies in Standard & Poor's boomed. And here we see the 5 top companies in Standard & Poor's, and they are earning a fair share, but it's approximately what they have been earning in the last few years. So once again, we see the same phenomenon. The market cap of those companies is becoming increasingly remarkable. How far can they go? We don't really know, but it's not very logical for this to happen. So why is that happening? There's many reasons to explain it. Some people say that these very low interest rates cause individuals to grow a lot, to invest a lot in companies with a very high growth rate, investing at 20 or 30 years. This could be a reason. But I think that the most important reason is the one that we are about to illustrate in the next slide, which is that the market has ceased to think to a great extent. And when you cease thinking, you do very strange things. The percentage of assets under management under passive investment has gone from being 10% in the United States in 2003 to 50% in the United States in 2019. I have written some books, and some of you know about this, and I've devoted a full chapter to passive management because I think it's a very rational way to invest with a very low cost. It's just a fee type of cost. And if you have no other way to invest, I think you should invest by using passive investment. But a decision that is valid for one single person may not apply to the whole market. And this decision leads to the fact that 50% of decisions made today in the United States in terms regarding investment funds when they invest, these are decisions that are not well thought through. They just consider that the company is large and their index is this or that, but they don't really consider the decision thoroughly. So this gives rise to very important distortions and very important opportunities both at the same time. And this actually reflects what's going on with us right now. We have an extraordinary portfolio, and we are going to illustrate some very obvious examples, but at the same time, this requires an extra dose of patience, because until something happens with these companies and until capital doesn't move from this type of investment to a more logical investment, which is something that always happens, by the way, as we will see in the end of the presentation, this will require an extra dose of patience. So this is where we stand. This is the general context, the backdrop that we are working against. And now we're going to delve deeper specifically into what we are doing. International portfolio. Well, 20% of our portfolio, and we're going to go into detail now, 20% of our portfolio are long-term contracts in the LNG chain. 74 companies plus one. And let's elaborate on this because it's really worthwhile. LNG is the way to transport gas. You need to liquefy it because you need a gas pipe. And if you need to make it travel great distances, there is no gas pipe that will allow you to do it. You need to liquefy it at minus 162 degrees. It's super expensive and it requires long-term contracts. And on average, the companies that we have in our portfolio, 82% 80% of the revenue is based on long-term contracts, and the average duration of those companies is of the contract, is 15 years, and that's for 80% of their income. It's like the famous highways, the good old highways, long-term contracts with solid revenue and very big counterparties, and a growing business, because this is a growing business too. Natural gas is currently the fossil fuel that better adapts to the current world, and there is a need to decrease CO2, and that is crystal clear, and it issues less polluting particles in urban areas. Well, it's a better fuel than coal and many other fossil fuel sources. This is why it's growing at 15% annually. 5% annually, and the perspective is for this rate to be sustained, and most countries are migrating from coal to LNG and from diesel and fuel oil to natural gas. So indeed, there is a great perspective going forward in very difficult times when fossil fuels are being challenged, but this is a growing sector, clearly. And as I said, this is based on long-term contracts, and there's been great price volatility. And by the way, I would like to go into much detail in this because it's very interesting. In the last few companies, Hoek and Exmad have increased by 21% respectively, but in the last 6 years we've had minus 24, minus 28, minus 34, and minus 1. This has impacted by a negative 6% the fund. A decrease of 6% in the fund, and without factoring in the coronavirus, and it hasn't affected the contracts of these companies. It's like one for all. Well, we haven't had an impact on this, but in net results, there's have been no impact whatsoever in this contract. But the portfolio has suffered the impact, and we're going to discuss what we expect from this, because we normally say that we would have to be very prudent, but here what we do is to put together a consolidated account based on our forecasts for the different companies. And here we want to talk about the LNG structure that we are invested. EBITDA is at $1.3 million. With the contracts, we will go to 2023, and we say 2023 because one of the most important contracts that the companies have will come in force on the 1st of January of this year. 1.7 million, 689 free cash flow, and at the top we can see the market cap too, which is 2.5 billion. So therefore, we are going to talk about 700 million free cash flow, which are generating 225 this year and 260 next year. They have some debts, these companies, because all infrastructure companies in the long term work with debt, all of them, absolutely. But it's a moderate amount of debt that will decrease over time, on the basis of the company's plans. So therefore, we're talking about an 8 times EBITDA, free cash flow, which is 11.3, and I think that figures are self-explanatory. But in case some people don't understand the dimension of these assets, let us set a couple of examples. The group of companies, of gas pipe companies in the United States, are listed at between 10 and 15 times EBITDA. And as we said, our companies are 8, 6, 5, depending on the years. They experience very important growth rates. So we're talking about very important discounts compared to those companies. And here we wanted to bring an example, that of the company Brookfield Infrastructure Partners, which is a Canadian company, a very interesting company indeed, because they bought the petrol activity from TK, the oil activities from TK. It's not exactly the same, but they also work in the infrastructure sector as they do. And this year, their EBITDA expectation is 2.1 million, very similar to what we are going to obtain for our assets in our companies. This company already has 14 billion in debt, and this is more than we have in our company. We're talking about 7 times debt EBITDA, a bit higher in relative terms. But the most important thing is the market cap of this company. Please let us remember that our market cap is 2.5 million. And I would ask people to share their opinion. But let's go directly to discuss this because their market cap is 22 million, 10 times more, 10 times more than our market cap. This reminds me of the case of Ferrovial. Ferrovial is a company that I think it's at 30 euros per share. I didn't follow very closely this past weeks, but they were at 29, and not that many years ago we bought this at 2 euros per share. It's a very good infrastructure company that have performed very well at the operational level and at the market level, and they have multiplied by 10 their investment. And this is a company that doesn't exactly do the same. They're more diversified, but they are present in many countries. They're in Brazil, in the United States, and across the globe, like many of these companies. And we have an enterprise value EBITDA of 17 times. I'm not saying that our companies are valued 17 times enterprise value EBITDA, but the valuation of our assets compared to other companies that are trending, well, this is quite significant if you make the comparison. Some people think that when we buy assets, we're buying assets that no one wants, that they have a doubtful reputation. But no, we are buying assets that are being bought by amounts that are higher than the ones that we're paying. So, of course, if we were to sell them, that we would get more than the 5 times enterprise value EBITDA that we're getting. So this is our job, and this is why we charge fees, because sometimes it's really not easy to find these things and to decide which is the right value. Trying to find these jewels in a market which is normally very well valuated, it's not an easy task. This is why a great percentage of our portfolio focuses on LNG infrastructures. And by the way, if you're interested in this, we have experts working on this field. And if any investors would like to know the details as to how these figures have been calculated, we will be delighted to entertain your questions and put you in contact with the people who are really experts on this. Because this is part of the job that we do, to find these values and discover their potential. I'm not going to elaborate all that much on this, but here I also wanted to mention Italy, because Italy is a complicated country, and Ivan is going to talk to us about it here. But 1/3 of our portfolio are operations that have sales based in Italy. 2/3 are outside of Italy. We have Danieli, Technicom, and other companies that are leaders in their sector. There are some other companies, such as, for instance, Danieli, were leaders in manufacturing steel sheets, so they are quite exceptional. And of course, we have out of fashion companies of the Brexit time with Dixos and Babcock, which are businesses that are very difficult to replicate, and we have explained them on previous occasions. And we do consider that after the black clouds of Brexit dissipate, they will start to bear fruit. We have 10% in Asia, 9% in commodities. Also, we have the case of Aritza, 8% is in Aritza. We continue to maintain our stakes. It has become one more company, a normal company. Early last year, the shares were at 150, and we sold 15 or 20% of our stakes. In the summer, the shares went from 150 to 0.70, so we rebought some shares. We consider it's just another company. This margins are below those of the competitors in the market, being a larger company, which is not logical. So normally the current management team or somebody else at some point will launch a restructuring process, and we really think that the assets are worth much more than are now reflected. And we also have shipping or maritime transport. We have 70% in the automotive sector. We've received bad news from Renault this year. The situation with guns and so on has made it become a more restructured company than we thought. We thought it was going to be a company that would integrate with Nissan, but this integration has been delayed, and these are, of course, causes that are a bit more minor, and the rest is, of course, 13%. But Ivan is going to talk to us about Cheer. As we know, they are undervalued, and this is going to be obvious for all of us. And by the way, there are some things that we wanted to highlight our portfolio. We've been with this shares with most of the shares for more than 3 years. It's not the same to invest in one value and get to know it as it is to have 3 years invested in that same value and in that same share and know all their operations. Here we have a picture of a month ago in Brazil. We were visiting one of the most important technical plants in Latin America, and this is going to commission in next year. And well, we asked whether any investors have visited them. No American investors have traveled to Brazil to actually see the operations on the ground. And there we were, seeing the mines. And it was a very interesting trip that we paid to the tobacco plants or manufacturing plants in the south of England. We have very interesting conversations with the operators, the maintenance lines for nuclear submarines, and you get to know very interesting information when you talk to these individuals, much more than you get when you talk to the CFO, and you get to know the relationship that they have with the English Navy.
We wanted to highlight this because when we say that the fund is worth 190 or 200 and that its stocks are at 85, well, we say it with much more criteria and trust than we did previously, and that's the reality. There have been some mistakes, but not so many. So what we foresaw has been fulfilled, but now we are sure about what we are saying. So there's an important point. Most of our shares are giving us some free cash flow. This portfolio is worth a bit more every day because it's always generating some money. We have said that 90% of our portfolio is creating free cash flow, and with very little restructuring. We talked about Renault, which is true. I mean, Aritza, we could say that it's also going through a restructuring, but that's mainly it. The rest of the companies are generating cash flow. And with what that entails, because every day they're worth a bit more, regardless of what their stocks say. And lastly, a reasonably defensive portfolio, long-term agreements in LNG in Italy. We're talking about the fact that it represents 15% of our stock. Well, Bartok from defense. So it's actually a defensive portfolio. It's true that we could say that 50% of the companies are cyclic companies, but obviously we are purchasing from companies that are not really invested in oil, so we're trying to get out of that sector in a reasonable way. So we could really expect. Well, we talked about the year 2000. I don't know if you remember this, but the 3 next years in our funds, we had a profitability of 40% with a market that was losing 50%. So we could see the market that is 15 times or 18 times higher than ours could fall 20%, and it could only be 12 or 13% what Standard & Poor's says, and we would be at 8 or 9 per. It's possible. It's true that when the market is against us, it's more difficult to have a good valuation, but in many of these companies, as we'll see later on, we will see good things regardless of what happens with financial markets. In Spain, we have a similar situation. We can say similar things. We're actually talking about very well-known companies here. Most of them are historical companies in our portfolio. Some new real estates. Obviously, they're new, so they're not part of our history. But we already know how the real estate business works, so we only use our knowledge in the right companies, and that's where we're investing. But we're also investing in the banking sector with some, I mean, it's a hot debate. We could talk about it if you want to. But it's a portfolio that, from my point of view, is quite simple, well-known. with strong conditions and with low odds of making mistakes. We did make some mistakes 2 years ago, but I think that was all of the mistakes that we were about to make. So in all of them are family companies. And in one of the companies, we're all shareholders, such as Bankia, so it's not bad. It's a win-win. And obviously, we trust in what the management team does. So now I'm going to give the floor to Andrés and Iván so that they can tell us about 2 investment cases that are quite interesting. Well, good afternoon, everyone. I am going to talk for a few minutes about ships. And we think it's interesting because it does have a bit of weight in the portfolio, and also because it's a bit controversial, isn't it? So before I start talking about ships and boats, I'd like to go backwards and set the context, because in the end, what we do in all of our investments, and this is just one investment of the many we do, is look for a good balance. So the value of the assets and the debt gives us a good support, and this in ships works because we've purchased companies where we have 50 to 100% potential when closing the company, because ships are assets. And it's also important with regards to this point in ships that we need to remember that ships are like homes, they're like buildings. It's a way of allocating assets, lots of money. This is what Greek and American billionaires do, because they know the market, and each of these ships could be worth 80 to 90 million euros, and they usually have some sort of mortgage like a home would. So it's an asset that has a mortgage and that you rent. You rent it as you would a building. So that's relevant. And the second point is the business itself. We want a good balance. We want a good business. So we want something that will last, that will not disappear next year or in 2 years, and we will not have a competitor doing things in a better way or in different ways so that they will erase us from the map. No, this is the cheapest way of getting goods from A to B. It's $2 per barrel to move oil from A to B, and there's nothing that pollutes less. This is the best way of moving goods from A to B. And if there is a sector that stops in the world, for instance, if the internet stops tomorrow, we will go back to 1980. But if this stops, we will be back in the dark ages, in the Middle Ages, because we will not have energy. So it is vital. So we have balanced business, and the third point is managers and owners. And this is a sector where we have actually chosen the best managers who are actually the owners of the company. So it's a very special sector, because in few things have I seen managers to be owners to always be managing, because in most companies, for instance in Italian companies, they might have some managers, but usually they just sit down with you. They tell you what they're doing, how they do their asset allocation. So they're really very honest, and we have companies that are number one in that method. So we look for balance, business, and managers at a good price, and that's what we look for in any company, and this is just one of those companies where we invest. And when we started looking at this in 2017, and that is relevant because obviously some people say that it is not our sector, and we have to nuance that, because the oil transportation sector, which is quite specific, it's not just goods, it's not just dry merchandise, it's something that has a lot to do with the oil sector, where we do have skills and competence, and then liquid natural gas also has to do with energy. So obviously this is linked to the automotive sector as well, so cars. So we're quite close to this. And then banks that finance this. We also have expertise in the bank sector, and we all know ship manufacturers in Korea. They're the ones who manufacture most of the high quality ships. So we did have some expertise in that sense. But after 3 years, we have even more expertise. But we wouldn't step our foot in a sector such as this one just for anything. And we saw that it was the lowest point, the cheapest point, the most stressed point in the last 30 years, and this is what we found. And this line here is what a ship is paid on a daily basis for its work. It's like a taxi or like the daily rent of a home, an Airbnb home. And we realized that did not cover the operation expenses on a daily basis, because you obviously have to pay your staff, and you have to pay for all the expenses. It cannot be under the daily expenses, because if that were the case, they would all have to close because they would be burning their cash, and it didn't even cover their debt cost. This is a house that has a mortgage. They have to pay for that mortgage. Otherwise, we would have to stop working. And obviously, there's profitability. Any fleet owner needs profitability so that they can renew it and keep on doing it. But if this business stops, we go back to the Middle Ages and the world stops. And we thought, this makes no sense. So as a minimum, the daily rent of a ship or an Airbnb, it needs to cover this level. This is the worst place in this 30 years. This is not something that can be sustained. We have to keep on working. So we worked a lot. And this our analysis coincides with the historical average. We have to cover this minimum costs, and this is what they have been doing for the last few decades. So this is a cyclical investment. As I said, we want balanced business and managers at a good price, and a very good way of investing in companies that have no problem whatsoever. Where we don't have to take a look at whether the owners are trustworthy or not, if they're about to go bankrupt or not. It's about looking for that low point in 30 years. It usually doesn't happen. It won't happen in a very long time. This is a unique opportunity that will not happen every 2 years. So we're here right now, and maybe we'll not talk about ships in a very long time. But our analysis led us to 4 main points. We saw that demand was pretty solid, and we saw that energy demand is not random, because if we were not to demand energy, we would go back to the Middle Ages. And then we saw some very special points, which are regulations, some regulation points. In October 2018, we approved it. And it will be enforced in 2020. Change that will limit emissions and will limit the way in which we pollute waters. This is a very strict change when we went from simple hulk to double hulk. This is a very drastic change, because the double hulk change was done progressively for a few years. When ships grew old, they changed. Well, this is something that all ships in the world have to do. This is the most drastic thing that has ever happened in the world of ships. So we thought this was a very important catalyst. Then there is the fact that has to do with scrapping. You know that especially with oil ships, that when they're 20 years old, they cannot keep on sailing. They have to be sold for scrap. So this low rent, the low lease per day, was forcing people to close down and to be sent for scrapping. So we saw that people started going to for scrapping. So this really changed, and we're going to keep on seeing this rate. So we could think that this was also a catalyst, an important catalyst. And the last one, which we think is vital, and we're always checking up on it, is what's the lack of funding. Because if the people who are in this business start making lots of money, which we believe is possible, then the market will go crazy and they'll ask for more ships. But we see that is not the case. There is a lack of funding because of the regulation against banks. And then banks also affect this in pollution. So everyone stops funding this. So there is a lack of orders. And when we saw that we were in that point of this 30-year cycle, and it did not make sense for this to go on, and when we see that things start fitting together, this gives us enough trust to start investing. And then we take a look at the rates that started recovering, and it made sense. So in 2018, they went up to very good levels, very strong levels, above the mean, the average. And last year, they were around $100,000 per day. So these boats, these ships, are 90 million euros worth, and they should generate 9 million per year. Well, at those levels, we were generating 30% of the value of the ship on a yearly basis. So it's like having a house and then lease it and having someone pay 30% of its value on a yearly basis. So at the beginning of the year, it usually goes down. But what has happened is that due to coronavirus, there have been some additional disruptions, and the market is now thinking momentarily. Well, they're thinking about this, and we see that there's still we can see the price per share. But this last month, if we take a look at the stocks of the values, we see that there has been a structural change. We're going back to the Middle Ages, maybe. I don't know. It doesn't make much sense, does it? Because energy consumption is not discretionary. So this is the list of the companies that we have had in our portfolio. Costamare is the one that is down at the end of the list. They create containers. It's not for petrol, for oil, and we have had a reduction of our portfolio, and we've reduced it to half of it. So this is an important graph, because since this has been a controversial investment, and since it is a very cyclic investment, it is interesting to say that our entrance was quite progressive. The lower line is the line that represents the losses or the profit. So we have always tried to make sure that we entered this cycle that could be volatile at a very low level during at that 30-year point, in order not to lose a lot of money. But in the end, it generated 4% in our portfolio. It represents 40% profit in this controversial investment that was not amongst our expertise fields. But we did it little by little and with trust. We were not betting in a casino. We were looking at what happened in the cash flow, and a boat that should generate 9 million is going to generate 27 million per year. It gives us much trust. And I will now give the floor to Iván. Thank you, Andrés. Good afternoon, everyone. So I am now going to explain to you why we thought that our investment in Circo Fide should make us very happy in the future. And I'm going to stop here a bit, because our intention is that everyone in this room could really understand what Circo Fide is, not just professionals, but everyone should know what this is. So I will start with a short description of what Circo Fide is. As you can see on the screen, Circo Fide is a holding company, an industrial conglomerate from Italy. And why do I say Tier and not Sear? Well, it is a company that is controlled by Benedetti's family. It is a company that we have known for over 10 years now. It is a company we have talked about a few times, but it's mainly a company that currently does not reflect the company that we knew in 2008. Why? Well, because now half of what it's worth and the stock is already in their cash, so in their treasury. And that's not all. They also have 60% of a company that we believe is the crown's jewel, which is Cos. The company is called Cos, and what Cos does is manage nursing homes and hospitals in Italy, and this is and in Germany, and this is very good business. And additionally, Cheer also has 57% of Sogefi, and what they do is they sell and distribute automotive components. And as we all know, this is a cyclic business, but that is right now at the lowest level of the cycle. And it's also a smaller part of the business if we compare it with the rest of the assets that they have. So as a summary, Cheer is a company that has lots of cash. It is a company that has a family that is always protecting our interests. And it is a company that has one main asset, which is Cos. That is a very good asset. And as I was saying, Cos is a very good asset. And I'm going now to describe both Cos as the sector where it plays. And for that to happen, I have to show you a map so that you can see where they are, what their size is, and I have to say that Cos is in Italy, and it is the sector's leader with around 8,000 beds. And although they're leaders in the sector, they only have 3% of the market share, because it is a very fragmented market. In general, the sector, not just in Italy, but in general, is a very red tape Latin sector. And if we consider bureaucracy and then Italy, we know what we have. You know what bureaucracy in Italy is. It's much worse than the one that we have in Spain. And at the end of last year, Cos purchased a company called Charleston. Charleston is a very small company in the German sector. It ranks as number 10 in Germany, but although it is small, it has 4,000 beds under management, and we think that Cobas purchased Charleston due to two reasons. First, because they wanted to diversify the risk in Italy, and secondly, because they wanted to be able to use it as a growth platform in Germany. And why is that? Well, because the nursing homes market in Germany is the market where we think we will see a greater growth and demand. And also, I told you that Cobas is the crown jewel for a tier. And why is that? Well, mainly due to this. The EBITDA evolution has been exceptional. In 2006, they had a profit of 6-7 million, and in 2018 it represents over 100 million. So it's been a 16th to 17th times growth. And if we take a look at this company, and they told us that we are not to invest in growth in companies that are growing. If this isn't grown, then I don't know what is, because you know that value investment is not opposed to growth. It's opposed to purchasing at a very high price. So now if we look at Cobas' growth, this growth has taken place thanks to the organic growth that the company has seen. So that means that they have more patients every year. Every year they will open a new nursing home or 3 nursing homes, and they increase their market share. And apart from this organic growth, Cobas has also grown thanks to small acquisitions. And something that's quite interesting is that although there has been such a good growth, Cobas has not increased its debt. And why is that? Well, because they have a very interesting policy. Only 25% of their assets are real estate assets. So this is a sector that is similar to hotel business. On the one hand, you have the buildings, and on the other hand, you have management. So that is how we add value to the business in management, and that is what Cobas is focusing on. That is why debt is more or less under control, 2.5 to 3 times EBITDA. In other sectors, this might be high, but in this growth sector, it is not that important. So as a summary, I would say that the main characteristic that we see at Cobas is that it is a company that is growing. And why is that? Well, because the sector has some very strong fundamentals. And on the one hand, the demography evolution makes sure that we can keep on evolving, and then entry barriers can protect our margins. I think that all of us in this room are aware of the fact that European population is growing older, but this graph doesn't just show that. It also shows that the percentage of people over 65 will be greater, both with regards to general population and active population. So we will need more nursing homes for the elderly. So the growth that we have seen in Cobas will continue. That's the most logical assumption. But we know that any sector that has growth will attract competition, and competition usually erodes margins. But in this sector, it is not possible. If I want to open a nursing home, I will find it very hard because I will need local government licenses. Why? Because this business is a regulated business, and most of the expenses are paid by local governments. And for them to pay what we're owed, we need to really know what the local regulations are. We need to know what doors to knock on. We need to know how to move around this bureaucratic sea. And not only do they know the local market, they also know the real estate market and the population around the area where you want to open a new nursing home. And why is that? Because a nursing home only has a radius of 10 kilometers where they really have an impact. And why is that? Because if I wanted to take my father to a nursing home, I'm not going to be driving 1 hour or 1.5 hours every day to go and see my father. Why is that? Because I will end up not going and not visiting visiting my father, which is quite sad. So the catchment area, you could say, is only 10 to 15 kilometers around the nursing home. So we really need to know the market, the real estate market, and know what population we have in the area. Another important point is reputation. Why is that? Well, because in this sector, we deal with people who have different personalities, different dietary needs. They have different drugs needs, and any error could be fatal. And what has happened with the competition? What have the other operators in the sector done? Well, here we can take a look at Orpea. Orpea is the main nursing homes manager in Europe. They represent they're 10 times the size of Cos. And here we can see that that Orpea's EBITDA has grown times 3. But the good news is that their stock has also grown It's actually been multiplied by 3, and that's not everything. We have to say that this sector usually has 25 to 27 times EBITDA, profit, or 14 times EBITDA. So as a summary, Cos is in a sector where the demography makes sure that the growth will take place. Cos is also in a sector where entrance barriers prevent a problem in profitability, and they're in a sector where competitors have very good results with high multiples. And all of this, how does it translate into benefits for Cheers shareholders? Well, this is translated into the following. Our cost assessment, just with cost, we already have a Cheers capitalization or market cap. And how have we gotten to that assessment, that valuation? Well, it's actually quite simple. I'm going to explain it in a very simple way, but I'm not going to give too many clues to our competitors. What we have done is consider moderate growth, but always being realistic, and we have applied a 20 pair. And why 20 when we always say 15? Well, because this sector seems to deserve that 20, and because it is a sector where competitors usually have it times 25. And then we have the cash we talked about previously, which is half of Cheers market cap, and 52% of 33% of SGFE, and this is what gives us 1.2 billion euros, and the average of the market cap is 671 million. So that represents 90% more than what the market thinks we will obtain. And what does the market say? Well, here we can see what the market says. In the last 7-8 years, more or less, shares have been almost flat at around €1 per share. It has been completely foreign to the growth that Cos had been witnessing. And why is that? Why hasn't the market shown this growth? Well, on the one hand, because what worries the market is the corporate structure at Cheer. Up till tomorrow actually, Cheer and Cofide are two different companies, separated companies, but on Wednesday they will merge effectively. Cofide had 50% of Cheer, and Cheer held the different shares. And if we do the math, we know how much each is worth. And the market didn't like that. So what did the company do? Well, they merged the two companies. And as I said, the day after tomorrow, this merger will be official. And something else that the market didn't like was the fact that when I talk to analysts, they would tell me, well, yes, Cheer might have lots of cash, but they do nothing with that cash. It's underused. But that's not really true. During the last 6 years, they have invested around 100 million euros by repurchasing shares. So they repurchased 13% of its capital, and they already have set aside 19% of the shares. And the company has also said that as soon as the merger is official, they might repurchase shares. And something else that they were criticized for was for the fact that they were too focused on Italy, a country with lots of debt, lots of bureaucracy, lots of political problems, and so on. So what has the company done? Well, as we have seen, they have purchased Charleston, which is in Germany, a richer country with a better business. And they have sold Jetty. To say it in easier terms, it is the Italian Monsanto. Vocento, the Italian Vocento, I'm sorry, not Monsanto. So with these operations, what they have done, what Cheer has done, is improve their operational risk, the company's operational risk. So on the one hand, they got out of Italy's cyclical business and they entered Germany with a much better business. So as a summary, during the last year, there have been lots of operations that have improved the situation. They have simplified the company, improved everything in the company, and the share has not moved really. That is why our conclusion is that this is a unique opportunity for us to purchase more shares. That is why we have 6-7% of the portfolio. And that was my presentation. And I will now give the floor to Paco so that he can continue with the presentation. Thank you very much. Well, thank you very much, Ivan. In order to finish, we're going to see how this valuation gap is closed. How for instance, this valuation, this Cheer valuation, which is obviously undervaluing assets, and that is why it closed. So we would like, first of all, to consider 2-3 basic concepts, and then we will give you some details about how we close the valuation. So the first basic concept we have already mentioned. It is the fact that we had to increase the value of our companies, of our assets, and we had to obviously not lose that value. Whether the stock reflects this or not might be important, but what's essential is for that value to be there and not be lost. So when a company generates 1 million euros profit per day, that company obviously is worth 1 million euros more every day, and that money will be paid to us as investors, or it will be used to reduce debt. For instance, we have this example of TGB. We've been investing in this company for 3 years now, and a clear example of how you create value, of how you can live value aside so that you can afterwards sow what you planted. We are going to take a look at the figures. For those of you who are not experts, it might be a bit difficult, but they're quite simple. If we take a look at 2019, the company is currently being valued by the company in 5.8 billion, 1.1 in market cap, and 4.7 billion as net debt. So what we're saying, 1.1 billion is actually 980, because there has been a 15% drop in this last month and a half. So this company, as we can see on the top line, is generating free cash flow, and we see that it will generate 150 million net benefit. So it's 1.1 market cap. So we see that it's 4 times net profit. We know that TK has all the fleet. 95% of the fleet has been linked to 12-year-long contracts. So we can say that this could be like a bond. There's no logical way for us not to recover those 250 million per year. So if we consider that profit, those benefits, that they're not investing, that generation of cash flow is dedicated to repaying debt so that they can repay the whole debt, it is not very realistic, but we will see what happens in 2 years. Well, those 430 plus 430 million, that's 860 million, that should be added to market cap because they have decided to pay debt. So if the market values all of the assets, all of TK's assets at the same valuation that they do today, we're not asking for that to be increased. At the same value, that would be 5,869 million, so 5.8 billion. Thanks to the incredible cash generation, then our cap should be 2 billion euros. So in 2 years, we will see if it is 1.8 billion or 2 billion, but it should be 2 billion. We should have a revaluation of around 100% with the same valuation for the assets.
That's to say, money will not fade. Money is there and it will generate value. But they're not going to pay the 430 million in debt. They will, of course, spare out some dividends, 75 or 78 million this year, depending on the debts, and the rest will be invested in repaying debt or invested in new values. But this is an example that goes to show how time is in our favor. Now, the more time that goes by, the greater the increase will be. This is something unattainable. It's like a hole under pressure. When pressure explodes, it's so strong that the lid just flies off and boosts everything around it. So it is indeed something that we will see in the next 2 years. It will be at 80 or remain at that same levels. But obviously, as we mentioned in the case of TK and then in the case of many of the companies that we are invested in, we know that the value is going to increase because they are generating cash. Therefore, our estimates as of today for next year value will be 198, and for 2022 it will be 210. If we have right now 126 revaluation potential, in 2022 we will have 186, and it'll triple in a few years. But this is not really going to materialize because, of course, the rate is going to increase. And in the next slides, we will see the different waves. But the main concept that underlies these two last ideas is that time is in our favor in the sense that we are constantly generating cash every day. So we need to be patient, and in due time we will see that show. We will see that cash show. And what Iván said about Chile, it's clear they were creating 100 in EBITDA in 2018 with their nursing homes, and this year it will be 120 million. So ultimately it will be 150 million in EBITDA, and our valuation is 700 million. In 3 years' time, it'll be 1 billion for those nursing homes. So time is in our favor in most cases. Normally, the more time that we remain in this situation, more things will happen. Some people will realize that there is such a valuation, and they will do an arbitration on this gap, and there will be some equity funds that will have a lot of capital, and they will come around and buy assets. For instance, gas assets as 13 or 14 times EBITDA, whereas there are assets available in the market at 6 times EBITDA. So there will be a convergence. It's not logical for this situation to remain for a very long time. So how do the mechanisms work? Well, the most obvious mechanism is the market. And we will go over it again, but at Cobas we internally have many discussions to determine whether we included or not in our quarterly newsletters that the value is always regained. And I challenge everyone to tell us whether if hasn't been a company that hasn't gone back to a reasonable value for any of its assets. And for instance, Corporación Alba, they are always listed as at a discount, and in 2005, 2006 they were listed at the value of their assets. So all companies, sooner or later, because this is a market economy that tends to be efficient. It's not always efficient, but it tends to be efficient always, and that ends up happening always, without a doubt. But then other things happen, and they accelerate the closing of this gap. The difference between the price and the value, and of course their buyback of shares by companies is a trend. And in Japan, they've gone for 25% to 40% of companies that are actually doing this. Our main two companies, Korean companies, are having buybacks. And I say this because they are indeed some of the companies that are more inclined to buy shares. And when you have cash and your valuation is low, it's very good to buy back your shares. So we have many companies in our portfolio that are buying back their shares. And also in Spain, family-owned companies that were reluctant to doing this, such as Prosegur or Melia, they are now buying back shares, and they're in our portfolio. So this is a wonderful mechanism for the price to come closer to the real value of these assets. And this is something that we always insist on with companies. Buy back your shares. If we consider that the assets are undervalued, you need to use your cash to buy back shares. And some of the companies that we are talking about, for instance, TK or LNG infrastructure companies, sometimes the structures are very complicated. They have a SOCIMI type of structure, US type of SOCIMI. So these are companies that are very well aware of how complex this is for shareholders, and sometimes it makes it difficult to invest because some U.S. institutions cannot be shareholders of LMPs, which are SOCIMIs over there. It's not exactly the same, but these type of companies are companies that they cannot invest in. So these are mechanisms that they're trying to change, and we will receive news about this soon enough, we think. So if there is a difference that we should highlight comparing what we do now and what we did in the past, is that there's more involvement with this type of shareholders. The regulation has changed, and this year we're going to be formally obliged to establish a relationship with the companies as such. But this is something that we did in the past too. We have a close relationship with the companies. We think that it's in our best interest to know them as best as we possibly can. We keep close contact with them, and involvement is about providing ideas to simplifying these things, doing these other things, buying back shares, having natural conversations, and better involvement. And finally, we've had some takeover bids, not that many, but in our last, in 2008, with the fall of the market, there were 5 takeover bids. This time, there haven't been that many. And nonetheless, we need to mention that the ones that have taken place that were very close to our valuation, which is something quite comforting. It goes to show that the prices that were paid were very close to our valuation. Therefore, things are being appreciated by those who should appreciate them. So this is linked to changes in the market that will happen in due time, and sooner than later, we think we will see changes in the stock price of companies that we're involved with, because there's companies that have so much cash, and it's so obvious that it's actually going to blow up in our face. And to conclude, and before we move on to the Q&A, we would like to insist on the fact that potential is great. We are buying at PE6, and we are seeing this in many of the companies that we are purchasing. And we are not just making this up. There's a lot of consensus. When we share these numbers, for instance, on LNG infrastructure companies, or CHEER, or TK, or TGP numbers, analysts and ourselves are very well aligned, and it's not that we are very visionary and we have a crystal ball and know what's going to happen going forward. And I think what's needed is the stamina and the adequate personality so that we can all wait for the market to prove us right. This is very important, actually. We have some pictures to illustrate this, because it's sometimes very difficult to convey the very high trust that we place on our assets. It's not tangible, it's not something measurable, but in reality, yes, time and contact with companies really improves the knowledge that we have on our companies and eliminates any uncertainties that we could have on them. And here we have another very important piece of information, that these portfolios are not correlated. No matter what happens with the markets, they're not correlated, and you see this with different movements that have taken place. And there's been a decorrelation for the worst in the last few years, and we think that there will be further decorrelation for the better in the next few years. And this is something that we mentioned on previous slides. Most of the companies that we have contact with show that they have clear awareness, especially the owners and the managers, but the owners are very well aware of the fact that they need to do something, because no one really likes for their assets to be undervalued and for prices to be below what they should be, and they're very well aware of the fact that they need to do something to solve this, and of course we support them in this attempt. And this is what we wanted to share with you, and the price and value will converge as they always do. This is something that is never changing. And we have 1 hour and 15 minutes to answer all the questions that you may want to ask now. Thank you very much. Hi, good evening, everybody. And we would like to greet those people who are following on social media and directly through Cobas. It's more than 1,800 participants plus 800 here in the room. We are going to start with a Q&A. Even though we are here with tablets, we just want you to know that the Investors Relations team has transcribed all the questions asked in writing on your cards, so we will try to group them all up and get started with the Q&A round. Participants insist on knowing what the greatest resilience of the portfolio is compared to indexes, because the general trend, as we saw in the closing of this presentation, they said that we are increasing above indexes when the market is growing, but when the market falls, so we fall harder than the market. So how resilient is the portfolio to offer that decorrelation that value investing offered in the past? Well, my last statement went along those lines. That was indeed the case until now. And what would be logical is for this to cease to be the case, because when you have a portfolio at a P 6.5, there is a bearish trend, which is very strong because you have the momentum of revenue that's given you a very important buffer. And when you're at P30 or 40, the possibility of falling by 70% are huge. So in our P6 portfolio, the possibility of falling sharply is very reduced. It's just logical. We're getting assets such as share, and their stock price could fall. Yes, it could fall, and nursery homes could fall, and their treasury in their current account could fall. Yes, everything could fall temporarily. Everything could happen. Let us think of 2009. There was a 62% decrease, and then there was an increase of 100%. So everything could fall. But in reality, we are generating money in all companies. 90% of our companies are generating money nowadays. Therefore, resilient is very robust. And we are getting very little for the money that those companies are generating. Good evening, everybody. One of the participants would like to know about whether value investment is still alive. Is this situation reminiscent of the past? I would tell this participant that, well, if someone offered to give him an apartment in José Abascal, or rather a nursing home at José Abascal, he wouldn't accept it because value is investing is dead. Well, we don't do value or growth. We just buy assets that are valuable, and we buy them below their price. That's what value investment is about. And if I get something for a very low price, I mean, how is it going to be trending to get something for free? It's really not trending, but literally they're giving us these assets for free. For instance, chair, annealing. They have more money in their current account than the company is worth. How would that not be trending? I mean, there is a very important concept that we need to highlight, but we have an industrial approach. We buy stocks because we want to share, to buy the whole company. And then if other people disagree, well, what can we do about it? I mean, intellectually, we're very rigorous, and we need to see what the discrepancies are, why we're right, why others aren't. And that's essential in our analysis. We need to consider what we bring to the table, why we are buying share stakes and others are not. What is it that we're getting right or wrong and the others aren't? So we need to come to understand this. But in general terms, we have an industrial approach. We are not being speculative. We are not really using a stock approach or a stock market approach. And we use the stock market to buy assets at a cost-effective price. But we go to the streets and no one has really given us a nursing home for free. People actually ask for money in exchange for that. We'd rather have access to it for free, which are, for instance, the shareholders who are selling shares stakes. So we have an industrial approach, not a stock market approach. And those people who are invested with us need to be aware of what we are doing, of what they are doing, because at the end of the day, we are acquiring a chunk of the company, a chunk of a cash flow, given 8% of profitability per dividend. And this is something that we're not getting at street level. And that's part of our work, of our job. And that cannot be dead. That cannot be not trending anymore. I mean, we know that we've had a very expensive market in the past few years, and well, it will normalize at some point. It's pure common sense. There is a question that has received many votes. We have suffered a lot with shipping companies in the past few years. Why haven't we made the best to get to the target price? I mean, why have we sold so many ship companies? So why haven't we harnessed the potential? Well, we've suffered more with LNG infrastructure companies than with ship companies. We haven't really suffered that much because, as Andres mentioned, with ship companies, well, LNG also transports ships, but it's a different type of business. What Andres explains is more speculative, of the speculative kind. And as Andres mentioned, we've made money with all entities, and we've sold at a very reasonable price. And most times when we've sold, the price is above the current listing. So I think that's quite clear. I could say, of course, that you can always do it better. I'm sure that there will be some people out there that have done better than us, but we are not really trying to get to the last cent at the expense of not managing risk. Risk management is essential, so we were very careful when we entered. We tried to not lose money. We earned money, and at some point we tapered it down, and we, in a way, have paid less for the fall, in spite of the fact that we are convinced that there is a long road ahead. But we don't want people to think that we are resting off our laurels, that we think that we have been very wise. We got it right, but we know that we could get it wrong. So we're also trying to manage risk. We need to have different criteria with this type of companies. With cyclical companies, the criteria is different compared to those that you invest in following other type of criteria. And 20-25 of our portfolio could be cyclical. And cyclical companies are not companies that can you be invested in for more than 15 years, but it makes sense to go in and out, harnessing the cycles of the sector at hand. And for instance, in the tanker sector that Andres mentioned, we find ourselves in a very cyclical sector, a very cyclical industry. And it's, for instance, like Acerinox. It's a typical company for us. We have been invested and we have de-invested many times, and our profitability has been much better compared to remaining a shareholder for such a long time. So it depends on your approach. They were asking us whether all your savings are still invested in Cobas, and also what's the bonus for workers based on? Is it aligned with long-term results as applies to other companies? Well, obviously 100% of my savings are invested in Cobas, and more so now because, as I mentioned earlier, part of my investments were in the other company. Last year I transferred it to Cobas, and the bonus is based on the company's results and each individual's performance, and as stated by law, and also because it's logical, half of the bonus needs to be reinvested in Cobas's funds, and the other half is available to each and every single one of the workers to use it as deemed suitable. And of course, that is a required obligation. We are going to shift gears a little bit. Many investors want to know how the traditional businesses that we normally invest in can be affected by CO2 restrictions or demographic changes or consumption changes, such as, for instance, not wanting to own cars. Do you want to talk about LNG? Yes, of course. Well, there's a lot of noise, and there's a lot of hypocrisy. For instance, the companies that we are talking about really have no established commitments, but they need to tick the box so that they can show that they're fulfilling with many aspects. But there are changes that are very interesting and that offer many opportunities, but there's a lot of investor madness, so to speak. people are investing in assets, for instance, solar plants with very low profitability. But we don't like that madness. Nonetheless, there are many other opportunities. For instance, in LNG infrastructures, we consider that we have found a very interesting area with great potential, because at the end of the day, LNG is a transition company. It's going to help us deviate from coal and from fuel and from oil. And it's an emerging company, so we find Color or Hertz which are playing in the field of infrastructures. There's a great investor appetite. There's many people wanting to buy these types of assets, so these companies are helping the world become cleaner, and they are helping people improve their quality of life, because if we want to steer towards cleaner energies, there are no alternatives. And there we are investors who are willing to roll up our sleeves and try and make money for our investors. And some other larger investors, such as, for instance, Brookfield, that Paco mentioned, end up buying businesses that indeed have a very large critical mass. This is nonetheless a very interesting opportunity, and in particular, energy plays in that league. Quite a frequent question in the last few years has been, in what market conditions would you consider closing the funds? I think this is something that we explained 3 years ago, and the explanation still remains. At 4 or 5 billion. For instance, actually, a couple of days ago, I was sitting with a manager with a UK company that was closed at 5.5 billion in 2010, and now they have 22 billion. And that creates a momentum. So the commitment would be 4 or 5 billion, and we are managing 2 billion, and we consider that the fund is worth double that amount. If we analyze the assets that we're managing, we are managing quite close to the amount that we should manage. We continue to talk about philosophy in general, and many investors ask about whether we are still not concerned about the macro environment with zero interest rates or negative rates. With everything that comes with that. I am personally very concerned with the macro environment in the long term, because 0% rates, that very absurd manipulation of interest rates, is something that will bring about consequences in the long run. The ongoing increase of public deficit leads to public debt of 100% of GDP with a 0% interest rate. When interest rates go to 4 or 5%, public debt will skyrocket. And indeed, this is a very clear concern to me. I've said many times that the only defense that we have against that is to own real assets. We will all have problems in that type of context, but some people will be more troubled than others. Those who are invested in fixed income products or have their money in the bank will lose value. But those who are invested in products that render services to society, ships or whatever, we won't suffer that much of an impact when that very negative environment happens. And there aren't many more alternatives, real assets or bonds or credits, state or a third party, subject to inflation. This is how it's all going to end up, with a very big inflationary process. I will read literally. I've been hearing for many years that you have invested in quality companies with a very low high ROCE and a P that is high. Have you gone through a deep value model? When will you invest again in quality companies at reasonable prices? I think we analyze them one by one, and the entrance barriers that most of the companies that we work with have are very important. Some quality companies have had temporary trouble and have opened the door to us investing in it. And perhaps we entered a company when they were falling by 40% and they have fallen another 20%. But in reality, we have shown that the companies that we have in our portfolio and the entrance barriers are very relevant. So when a company has a return on capital of 30%, that return on capital is there and it speaks loudly. I mean, it's not just a figure. It's saying that you will make more money than normal. On average, companies make 8 to 10% because it's the most that the market allows for. When you're making much more than that, you're doing something that is not easy to be paralleled. So my feeling is that we haven't changed anything. This is a very extensive question, but I will try and summarize it. Can we provide an explanation as to the very high rotation or turnover of our portfolios? Does this have to do with the philosophy? Yes, we always explain this, and there's very little turnaround in terms of names. For many years, we've been talking about the same names, and what we do is to change weights from one to the other. We have increased our stake in Share remarkably this year from 2 to 6%. And we have decided to invest more in this company. And so there is some portfolio rotation, but it's obviously because when a company falls by 20-25% and another one increases by 20-25%, we make the best of those movements without really making the names rotate. You don't need to make an additional effort to leave aside companies that you know very well. I mean, you just change the weights. It's absurd to not try and make the best of that. And the market is very absurd. They're evaluating very big companies at very big prices, and they are giving a bad name to others. So we just try and make the best of the situation. Paco, they were asking whether you really think that the current portfolio has more potential than any other that you've had in the past. Well, except for that of March 2009. Actually, when I was reviewing the presentation the other day, we were saying that it was worth 350% more. And the international fund was at €9, and we said it was worth 40. So, except for that point in time, this is a point in time when we are having more real discount over the value of assets. And they were asking about the quality of the portfolio. Yes, I think it's the best quality that we've had. And I really think that the team that we have right now is a wonderful team and the best team that we have ever worked with. Now we all have much more experience, and there's been mistakes. We've made mistakes, and they've been mistakes that I need to own, for instance, in the case of Aritza, but we have a wonderful portfolio right now. And it's very difficult to introduce new companies in the portfolio. We have many potential candidates, but it's very difficult to actually eliminate LNG infrastructures or TK. It's a company that's worth 1 billion and they're making 250. Actually, I would like to challenge you. Does anyone have a better idea? Please, because it's like a joke, actually. Literally, Paco, I continue to not understand many positions in the top 10, except for International Seaways or Israel Chemical. They have fallen by 35% since they entered. Well, this is why they're at the top 10. If they had increased a lot, and normally they wouldn't be in the top 10. And those that have had a very big increase, we've sold them. For instance, Chemical, we had a very big percentage of the portfolio. When they got to 1,400 shekels, we sold the whole stake, and now they are at 1,400 shekel, and we bought at 1% of the international fund and at 6% of the large company fund. It's about value and price. It's a very simple combination. There's no love, no hate. It's just value and price, and being knowledgeable about your companies, of course. Earlier on, you talked about Renault, but the case of Israel Chemicals is very interesting. This has happened this week with another company. There are 2 or 3 companies, actually, that we have purchased, sold, and repurchased again. This is a virtuous cycle that we have entered. We are getting to know the companies very well, And we are getting in and out because companies increase by 80%, they fall at 40%. That's happened with Israel Chemicals. And many things happen actually. And most companies in the portfolio have decreased. Actually, the fund that we purchased has fallen by 20%. Yes, there's been a set of values that have fallen by a lot, but that's the past too. We've had positive profitabilities in the past that can now be extrapolated in the future. And the same applies in the opposite way. And it's also justified by the numbers of the companies.
You also talked about Renault, but it's true that there are some questions about this company. I am going to read a few of the questions about Renault. They talk about a competitive advantage of the company. On the other hand, they ask about the reason why the drop in sales, well, if it is generalized or if there is some technological disruption that could increase costs in the future, if it was a mistake to think that the merger between Renault and Nissan was possible. And they also asked about the automotive sector in general. What do we think about it? Would you like to answer that question? Hello? No? Can you hear me? Okay, now. Well, Paco has said previously that it's true that it has now become a more complex thesis. Now we have a restructuring phase that we don't really like. But I think we should stop and explain certain things about this, about why this change has taken place, why this thesis is more complex. So we need to understand, all of those who have been reading what has happened with the company during the last 18 to 16 months, ever since they arrested Carlos Ghosn, the general director. There has been 2 changes of CEO at Renault in just a year. There have been 2 changes of CEO at Nissan as well, and the companies have been focusing on internal disputes and disputes amongst each other, having a dialogue with the governments of both Japan and France. Last summer, they were on the brink of having a merger between Fiat and Renault. So as a conclusion, they have been focusing on other things and not really the business itself. So I'm trying to answer to the competitive advantages question. It's true that Renault is the small percentage of the portfolio, or a small part of the small portfolio of the portfolio that doesn't have a clear competitive advantage. We never said that they had a clear competitive advantage because the automotive sector is a very cyclic sector. It's not like premium companies such as BMW or Porsche that do have a competitive advantage because of the brand, but Renault and Nissan don't have that advantage. So what happens when a company where there isn't that clear advantage, the management team does not dedicate all of its energies in the business itself, then things can happen as they're happening right now at Renault. They have been publishing the results last week, both Nissan and Renault, and they weren't good results for 2019. So we need to understand the reason why. And actually, we internally have been dedicating much time and effort to this because, as all thesis, we have to focus on Renault and the automotive sector. We weren't really surprised because of what I just said, because the management team has changed twice in both companies, and they have been focusing on other aspects and not so much on the business itself. And more, and specifically in this moment in the market where there have been tariff wars between China and the US, Brexit, companies decelerating in both volumes and prices in industries such as Germany, China, and then coronavirus and structural problems of the sector. You have to invest a lot for electrical vehicles and so on. So that is about understanding why they find themselves in that situation, why Renault is in that situation, why our investment thesis is now being modified. So in a company that has been forgetting about business for 1.5 years, if now the current management team that is a good management team, both Renault and Nissan and the CEO got here in July, and now they have an interim CEO. If they focus on improving the business now, we don't see why the situation should not improve. And besides, if you remember this, because we talked about the automotive sector last year, and we said that the main pillar of our thesis in Renault, in this case, together with Nissan, was the operational integration in both with companies. Many news have been published with regards to the fact that the alliance might be broken. We have dedicated much time to it. We've talked to the company, as we usually do. We have been checking the information, and we have drawn the preliminary conclusion of the fact that there will not be broken alliance between two companies. Actually, it's quite the opposite. Considering the circumstances that they both find themselves in, they are in a very difficult moment with bad results and so on. They are now accelerating even more the operational integration, and as a matter of fact, in May they will be presenting their strategic plans, and the Mitsubishi, which is the third partner in the alliance, will also be presenting its results that same day. So it will be Renault, Nissan and Mitsubishi. They will talk about a cost reduction, a massive cost reduction. Renault wants to reduce its fixed costs 20% in the next 3 years. And the second pillar of the strategic plan will be clear lines for the integration of this alliance. So clear lines with regards to R&D, with regards to purchasing, so making a solid alliance. So what we have been reading, what we have been considering about what has been said in the press is something that we do not agree with. And why do we think that our thesis is not wrong? Because the main pillar of our thesis is integration. Is still present, and this has to be in the context of a price, because nowadays Renault, what it's worth on the stock exchange is what its shares in Nissan is worth. So the financial business of Renault that generates 900 million cash flow and that has a 6 billion value in the books is worth nothing according to the market. And the 3.5 million cars that Renault is selling, that doesn't generate much cash flow because, as I said, they're investing quite a bit. But the market, the negative analysts think that in 2 years' time they're going to be generating 1 billion in cash flow. That's something the market considers is worth nothing. So we need to understand that this is a context, is a complex thesis, but we think that the market is wrong. So putting all of that in context, this is the summarized circumstance of what our thesis in investing in Renault is currently. Now, linking this to Renault, they ask about the Porsche thesis. Well, the Porsche thesis was explained last year. Our thesis with regards to Porsche is that this is a company, well, Porsche is the holding, really, that has 33% of Volkswagen. So it's an automotive company that we all know. And Volkswagen is not just the brand, but it also has many brands below it. They have Audi, that sells as many cars as BMW, for instance, Porsche, luxury brands such as Lamborghini, Bugatti, then Seat. They have also a truck division that has now been, that might be sold. A year ago, they offered selling it. So if we analyze all the parts within the company, we consider that it's worth much more than what is currently reflected in the stock price. And it's worth more because it has an additional discount if you purchase it through Porsche, which is a holding that has 33% of Volkswagen shares and 10% of the voting rights. And there is a new management team, and I go back to the importance of the management team in the automotive sector. A management team that wants to crystallize this value. They want for that value to bloom. So they're doing certain things. They now have listed the truck division. They are thinking of selling the luxury brands, so they really want to show that value, and this is our investment thesis. So how's the Bangkok turnaround? Is it the same situation after Brexit, or has it changed? With Bangkok, there must be some sort of a mistake because there is no turnaround. In Spanish, turnaround means changing things, and Bangkok has had a very good situation. And Bangkok, just to remind you of what it does, it just is the support for the British Navy. It has the oligopoly of nuclear submarines, 75% of the other military ships, and these were areas where we did not foresee an impact with Brexit, and as a matter of fact this is actually intact. But what we did see is that Brexit did have an impact in the market with regards to the filling of the market in the British and the London market. And we could purchase a company that was very, very cheap due to Brexit that actually did have no impact on that company. Where did it have an impact? Well, after 4 Brexit years, certain decisions have been made. For instance, some agreements have been postponed, some contracts have not been signed or have not been issued when they were expected. So what has happened is that the initial growth should have been 5.5% and it has only grown 0%. And this obviously has had an impact in its stock. But it hasn't had an impact on the results. Babcock's profit is the same. As for what do we expect after Brexit? Well, the official exit of what took place on January 30th. That's when Britain exited. And now we're in February, so it's a bit soon still to be able to give you some sort of assessment. We do have we have a good feeling with regards to the outcome because of the contracts the agreements that they signed before Brexit. But in the end, Babcock is actually a lot of contracts, a lot of agreements. It's very diversified. So bad news don't really have a very strong impact, but actually good news don't have a good an important impact either. So it's just about price and value. Thank you very much, Juan. Now, one question for Carmen. If you could talk to us about Dixon's thesis and how the restructuring in the cell phone field is taking place. I think she's speaking, but without a microphone. Carmen? Hello? Hello now. So, good afternoon. Dixon's thesis is the same that we had a year ago when we introduced it to you all during the conference. They're number 1 in electronics and cell phones in the UK and in Scandinavian countries and Greece. They have a very good protection due to the entrance barrier and with high profitability, and they can compete against online parties, and they have grown quite a lot when compared to Amazon. And not long ago, they gave us their figures with regards to online sales, and they're also growing online as well. This is a company that is going to generate lots of cash in the next few years. Their management team want to transform the company. They have a plan that will generate £1 billion cash. And this plan was a 5-year plan, but it is going better than expected. So they have decided that the results will be achieved in 4 years instead of 5. And what's best about this is that we have all of this thanks to Brexit. So it has a per 7 when its main comparable in the US is per 14. So I'd say that the thesis hasn't really changed. And now as for cell phones, it's true that the shares haven't just had a bad result due to Brexit. And they have done 2 things. On the one hand, they have renegotiated the contracts that they had with operators, with telcos. So now they don't have volume commitments, which is what has forced them to reduce prices because they lost money because they wanted to fulfill those engagements. And from 2021 onwards, they will not have those engagements. So they will be able to offer the products that clients are really demanding. And then they have a cost reduction plan for Carphone, which will be 200 million. So with all of that, they expect for this year to be the worst year, the one closing on April. They expect to lose 90 million. Next year, they will have a better result. And then for the next year, they will have break even and they will not lose nor gain money. And from then onward, the business will start generating profit. But the best thing about this is that even if this doesn't work and if they don't generate any profit, it will be a business that will generate much cash flow because the contracts that they have with telcos, with operators, have a certain accounts payables that are very high. So they will generate cash flow for the company. So regardless of what happens, they will be generating £500 million. And then they have a further protection, which is the fact that even if the restructuring plan doesn't work, Carphone stores have a very low low-term lease contracts, so they could stop selling cell phones and start selling electronics. So the restructuring is having a very good result, but even if it didn't have a good result, they will still generate cash flow. Daniel, they tell us that if they have more cash than market cap, what opinion do we have with regards to the management team, and have we suggested them to repurchase their shares? Yes, we have suggested it, yes. Yes, Danieli, what it's worth in the stock, they have it in their cash. And why is it so cheap? Well, because the market tells me what they told me about Cheer. They have lots of cash, but if they do not repurchase shares or if they do not pay out dividend, what is it worth for me? But what I see, and actually we have been talking to the management team, we have been suggesting them to do share repurchasing, and they're considering it, but we're not as positive as in the case of Tier. What's good about Danieli is that even if the company doesn't do anything with its cash, it's a company that generates around 100 and 120 million cash flow on a yearly basis. So if I forget about their cash, they would be per 9. Because their profit is not very buoyant right now, but we have the backup of all the cash that they have. And something else that the market does not see is the fact that Danieli is linked to new investment in steel factories or plants. They are focusing on a very specific kind of steel, but that's not really true, because in the steel sector there is overcapacity in the initial stages, but then there is they lack capacity for finished products and added value products, and that's where they sell a lot. And it's also true that still much investment needs to be done in environmental improvements and efficiency improvements in all of their plants. So the market has painted that stigma on them, but actually Danieli has two main competitors, and those competitors are going through a very bit of a complicated time. So the big contracts are all falling on Danieli's lap. I think that they have the biggest purchase track record in their history. Yes. And we also have to look at how we build our portfolio and where we place our investment, because the case of Danieli and Cheer are interesting. In both of them, we had 2 to 3% of the portfolio 1 year ago. And then we met with them, we were with them. So clearly we saw that there was a willingness at Cheer to generate value so that the value could be seen in the stock. It's not that they said it so openly, but that's the feeling that we had. And it's the same thing with Danieli, because they didn't really worry about the stock values, because you know that money is a scarce resource. So we try to invest in those companies where we see that they have more possibilities of generating value in the short term. So we still own 2 to 3% at Danieli, although it is a great company, as Ivan just told you, that is undervalued. But we insist in companies such as Cheer, where we do see that the company is willing to simplify its structure, to paying dividends to shareholders, to buying back their shares, where we see that value could be multiplied in the short term. So we have been mainly focusing on those that have optimized their portfolio. So that's what we can do. I mean, we can't really pay for candles and so that saints will favor our portfolio in this or that company. This is our strategy. Thank you so much, Ivan, and we will continue with you, Paco, because they're asking whether Aritza is now getting its market back in the US, if there is a possibility of if there could be a takeover bid. Well, yes, Aritza is doing a restructuring, because as I said previously, they have value lower than market. I understand that in the end they will have the same margins as the market. We don't know if it will be this year or in 3 years' time. And the company is battling in that sense. It seems that they're recovering some contracts in the U.S., some of the contracts that they had lost, and they're telling us that they will have positive sales in the U.S. during the second semester, which starts now this month. So, well, yes, obviously we do not think that there might not be a takeover bid like in any country where we invest, because we do think that there is an interest for their assets. In this last few years where we were shareholders, we saw that they were interested in the assets. There was interest for the assets. The assets are good, so they will generate interest. So one way or another, we understand that value of the assets will be seen, will show. So what is the Milan thesis? How do you see the generics and general market, which has been punished? Vicente, would you like to answer that question? Milan. Okay, Milan and generics. Well, good afternoon. Can you hear me? Yes. Well, no, I'm sorry. That microphone was off. Milan is a pharma company. They are the world leader for generics together with Teva. And now they have announced their merger with Upjohn, which is a Pfizer subsidiary. So the investment thesis here is that we have a company that is world leader, that generates cash, that is listed at 5 times its profit. I don't think that there are many pharma companies in the world that have these results. And the thesis is based on the fact that they have one of the best complex and biosimilar product pipelines that is more interesting in the market, and they're launching them right now, and it will be progressive in the next few years. And we think that this is an opportunity, a very, very attractive opportunity. Could you talk to us about Rio Tinto and the mining situation? Well, Rio Tinto, would you like Juan to give an answer, or I could give a few brushstrokes? I think it's a very interesting company. They have their headquarters in Chile. They are listed in England, and the assets are Spanish. It's actually quite a network of things that make it not very well valued by the market. Would you like to give more details, Juan? I think that you have basically said everything that is to be said. It's a very small company. They shares are not being bought or sold in the market, and it is a company that doesn't spark the interest of foreign funds. Spanish funds cannot purchase because they're listed outside of Spain. So we changed the brochure at the beginning. I think it was in 2017, so that a company that has all of its assets in Spain could be purchased for a Spanish fund, and that's what we did. I don't know. I don't know if I've answered your question. What is your opinion in the midterm with regards to Sacyr and its strategy with subsidiaries or branches? Well, Sacyr was an investment where we increased our position at the end of 2018 because we saw two important things. First of all, as you all know, Sacyr has some procedures open with the Panama Channel, and in December they paid a certain amount of money, and from that moment onwards the procedures were not relevant any longer. And on the other hand, we saw something that was very interesting, which was the fact that the market was seeing Sacyr as a building company that was indebted. And I've explained this to many analysts, and some of them didn't understand that at the time. What we saw at the time was not a construction company that was indebted. It was an infrastructures company that was planting its seeds. So many of the assessments or the valuation that we do or that any analyst does depends on the concessions, and this has a very important there's a very important element. 90% do not have a traffic risk. So whether there are cars going through those highways or not, they will get paid. And the market realized that. And in June, the company did an investor's day explaining in great detail each of its concessions. And what do we see in the future? Well, we see that these concessions will start generating cash flow as they start being open and they start working, and after the launch phase, because you have to remember that a concession from day one will generate expenses that will little by little decrease, and then the return will increase. So what do we want for these concessions in the future? We want them to have a growing EBITDA for the company, so they will generate a greater cash flow for the company as well. Sacyr case is actually quite similar to the BMG infrastructure that we were talking about previously. Sacyr was a company that was well valued within an infrastructure sector that was very well valued, but they were kind of the orphan in the market. But now they're being recognized for their value. And that is what happens to our companies, our infrastructure companies that are usually perceived as ship companies, when actually you have something that is much deeper than just ships. Within the real estate sector, what are your main arguments to give more weight to Aedas than Metrovacesa? Well, actually, our stakes are very similar in one and the other. There isn't really a difference between the two. So the premise of this question, it would be 1.3, 1.2, 1.3 is one and 1.2 is the other. So it's quite symbolic. We don't think that really there is a difference. I think they're quite similar. They all have their pros and cons, and they all have their advantages and disadvantages, but they're reasonably similar. And that's the general thesis in the real estate sector in Spain. We haven't built in the last 10 years any homes except for Malaga, where we won't stop building, but the rest of Spain has really put the brakes to construction. So there will be a positive cycle for some time because no homes have been built for some time. Okay, so linking my question to Gemma's question, I will talk about Coabit because we like it. Do you think that they will be able to pay their debt since costs are going upwards and adjusting the price of apartments? This is linked to what you just said, actually. Well, yes. Yes, if you want, I can talk about them. Yes, in the end, they have assets that are worth 560 million euros and a debt that is 250 million euros. So it's 50%. If we consider that their assets, if you consider the million square meters that they have and you consider the capitalization, you're talking about 300 euros per square meters, right? So half of it has a debt. It's true, but these are square meters that are well purchased, so they're good assets. So yes, the debt is an issue, but in the end, they always have the resource of selling their assets because obviously the assets are good, and they could even sell them the book value, and they could pay the debt, and they could pay their investors as well. So there is some debt, but it's reasonable, and maybe we should highlight something. They already have pre-sales, 1.7 billion houses that will generate cash flow. It's foreseeable that much of that cash flow will be dedicated to paying the debt that they have. Okay, so we have amongst us an investor who is an expert in hotels and restaurants, and he wants to know why we want to invest in Meliá, because the results are quite mediocre and the results are poor. So could we explain our Meliá thesis? Well, it's 14-15 euros per share. That is the assets valuation. We can believe it or not, but it's signed by solvent people, and it's around 7 euros per share. That's with regards to assets. And Meliá, we all know what Meliá is. They have had some problems last year. It's true, that have led the prices to the current situation, and we think that the asset valuation, as well as the potential that they have to develop in Asia, where they have an idea of developing themselves, not just so much by purchasing the hotels, but by managing the hotels, is a very good plan. So I think that it's a good idea to be one of the company shareholders. I don't know if you want to add something, but I think it's quite a simple story, and it does generate cash flow, and it has a very low debt level, the lowest they have had in the last 15 years. Never had they had such a low debt. This is a reasonable debt. Well, you've already said it. Part of the bad results that they have had, we think that many of those bad results have been one-off. They had the problem of the Caribbean, safety problems in the Dominican Republic, and these are things that could be improved, and the benefits will go, or the profits will go back to the normal state. We also have to remember that we always have to invest when something bad happens in the companies, because if everything goes well, Amazon, for instance, their shares are listed at 60 times their profit. So that's, our world is not that world. We get opportunities when something bad happens, and in some cases we don't see anything negative, and opportunities are amazing. But usually something bad really usually happens, but it has to be something temporary, not something permanent. It's like what I'm referring to with regards to Melia. What is the differential advantage or the main advantage that we see right now in... Who would like to answer this question, Juan? Well, the main advantage with Gestamp, the main advantage that we see, because we talk a lot about technology, but what we really see is their relationship with their clients and their plans. It took them some time, but in the end, in order to become a tier 1 supplier for instance, BMW or other automotive clients, is an extended process, because if one of the pieces fails, and at a BMW there's an accident with people in the car, the reputational damage is very important for the brand. So the process that a company such as Gestamp has to go through in order to have that certificate and be able to supply a very high level of pieces to a client such as BMW is a process that is quite long in time. So this is an entrance barrier that prevents anyone from setting up a business that is similar to Gestamp. And the second reason is that Gestamp has its plants very close to its clients' plants or factories. So in the end, when you have a global configuration, the models are being done globally in platforms, for instance, in the case of Renault and Nissan. So when they ask for pieces for a certain model, they don't ask you for 500,000 pieces, they ask you for 2 million pieces. And if you don't have the capacity of having a geographical extension that will allow you to provide those pieces for the factories that the company will have in Mexico and Korea and in Europe, then most probably the manufacturer will not give you that, will not award you that contract. So I think those are the two main pillars at Gestamp. Now, changing topics. Different investors are asking for the MSCI value. If it is so cheap, why should we invest in Cobas instead of investing at other indexes that are lower? And the second question, which is quite recurring amongst investors, is if you will have a reduction in commissions at the Cobas funds. Well, the index, I don't know I don't know how they get that. I don't know what is the price they're listed at. But I see other value funds. I see the index. I see our fund, and I still have all of my money in this fund. I don't know what that MSCI value is, and we would have to analyze it to see what it is made of, what it isn't made of.
The problem with indexes is that ultimately what they're doing is to conduct a very quantitative analysis. They take the PERs, the prices, and there are a lot of banks, a lot of commodities, and lots of everything. But once again, they're not applying too much of a straight criteria, and we are not invested in commodities or LNG just because we are keeping a close watch on what the cash is going to do, and it's very specific. So that's what I wanted to mention about indexes in particular. And indexes based on criteria or factor-based investment, what they do is to conduct that type of selection. And in a way, they follow a certain extent of criteria, but not that much at the end of the day. By the way, to the other question that was asked earlier, we could compare this to the value, for instance, banks, which are the cheapest in the market. Well, in spite of what some people who asked questions earlier said, we try to find the best amongst the cheapest. So quality companies that are cheap. So it's something that goes a bit beyond buying the cheapest in the market. We've already said that we want to increase the fees, and it's just because we consider that this is a very good business, but this is not a business that is excessively buoyant. And actually, the financial system has been charging 2% traditionally, and we're close to that. And we think it's too high. We think that we need to share with customers because they need to be benefited by this, and we're going to decrease the fees. We are not going to say when or how, but our commitment is there, and it's not going to take long. But we will decrease fees for sure. This doesn't mean that we are not generating value, and this doesn't mean that now the figures are low, we're going to reduce fees. No, it's not related to that. It's rather a structural problem. We have put together a fund that is very positive, very good, even though the stock prices do not really reflect that. And it's worth what it says, and it has very good ideas and very interesting ones, and it's rendering very good results. But it doesn't necessarily mean that we cannot decrease fees. We will decrease them. They're asking us about the liquidity risk that our funds have, and also they want to know about the leverage degree. Well, there isn't much of a problem with liquidity. I've had many experiences with complicated liquidity situations, and you always find a good match. I mean, there's always someone who's interested in buying them. There's always somebody who's going to be interested in buying a company at 7%, for instance, Cheers package. Now we have 6 or 7% of the company, and undoubtedly we will be able to find investors that we will explain the thesis to, and they will be in a position to buy the company. And in spite of problems with liquidity, because sometimes we are buying companies that are technically not that liquid, but our experience is that they always have good stocks at a good price. We don't see there's a problem of liquidity in our investments, and we always try and have ultra liquid values in case of urgency, but we've never had such an emergency. And what was the other part of the question about the leverage? Well, in LNG, it's 6 times EBITDA this year, but for the rest of the portfolio, no. Fundamentally, there isn't leverage. There are some minor cases, but in general terms, there isn't debt. There isn't much debt, or there isn't that much cash. And for LNG, we've seen that we have 15 years, and leverage makes sense. And Brookfield has very high important levels. Some LNG companies have been bought at 14 times EBITDA with 10 times debt EBITDA ratios. So this is a sector that works well with debt and with long-term contracts. They're also asking about whether the different falls in early this year, we've seen difficulties outside the sectors that we normally work with. And the same investor asks whether we are not over-focused on a very specific type of company. I don't know, could be. But in reality, what we've done is, for some of the companies that we've mentioned here today and who have experienced growth drops of 20-25% without any news or justification, we have increased our position and our investment there. And this month, we've had some companies that have performed well, and we have sold part of those to purchase others. And once again, it's what we mentioned earlier. We are making transfers from what's doing good to what's doing bad, because those that are performing well are close to their stock value, and the opposite too. And in cases when we are buying, it's because we haven't received any negative news, and some of the things that have actually happened could be interpreted as very positive things. And by the way, when we publish the quarterly results, irrespective of what the company stocks have done, the target value will continue to improve. How do you factor in qualitative aspects into the objective value of companies? Are they just used to establish an order of priorities in terms of investment? No, they're taken into account to a certain extent. I mean, Ivan explained how we valued costs as part of Chill, and it's evaluated 15 times above profit, which is quite frequent. When there's a business that's difficult to replicate. And on top of that, there is a real estate component and it's owned by a good family. Then in that situation, you can increase the value. But that is an exception because we understand that all companies that we have are well managed, or most of them, and this balances out all of them. And in general terms, we are talking about very good businesses, but the trend to apply 15 times profit, it's only natural. There are some exceptions where we apply higher multiples with elevators or chairs, or lower in commodity companies. For those, we do lower valuation. Another question that I think we must ask, and it's very general, but it's very open. Are you concerned about coronavirus? Is Cobas' portfolio worried about the coronavirus? Well, we are concerned, but everything passes in this life. We've seen what happens with ships, with transfers, with contracts, and we have analyzed the things that have happened. And when we see that nothing is happening, we will be reassured. And if we see that things happen, if we need to change our evaluations, or some of them, and if we have to change some of our assumptions, we will. But in this case, we consider that perhaps it would be most affected in the maritime sector, and given the movements that there are there. But most of our investments are subject to take or pay long-term contracts. Therefore, the customers of those infrastructures either pay and use them. So there are no other alternatives. I think we're very well invested and protected. And I think the market is creating a lot of noise, and it is temporary. The stock market in China fell a lot last week, and they're recovering already, and they are the ones who are taking the most pain. So they were asking us about the percentage that Cobas invests in large companies. And also there is someone who has stocks on Cobas concentrated, and he would like to know how it's managed. Well, Cobas large companies is a fund that we have for when we have to close Cobas International and Cobas Selection. So we're far from that. I personally have an investment in Cobas large companies, or large corporates. But I would insist on International, Selection, or Iberia, which are the portfolios that I consider have a better value right now. Large corporates is a great portfolio, and we give it a lot of love, but it's more logical when the other funds are not available, because it's easier to find value in smaller companies. And as for Cobas concentrates, we try to include the best ideas that we have in our portfolio. For instance, in 2018, Aritza's choice didn't perform well, and it did have an impact, but the tanker selection had a positive impact. As Andres explained, my experience with concentrates is that you get more profitability than with the selection fund, but you cannot really talk much about the concentrated fund publicly because of the regulation. With the dollar at 1.09, is this coverage penalizing us? Have we really missed out on the revaluation of dollars because of coverage? What percentage does this represent for the portfolio? Well, we were hedged at 1.09. I mean, we were at 1.05 for starters, and then we've gone to 1.09 or 1.10. And in this last few years, we've lost the coverage. But fortunately, it's very limited because of how low interest rates are. So it's about 1%. Frankly, we'd rather do this because the dollar is at the very hard part of the range, and 30% of our investment is in LNG infrastructures, and there is great potential there. But we don't want to have that potential ruined by the dollar, by a 25% decrease in the dollar. So we'd rather pay that toll, 1% every 2-3 years at any rate, and until that is availed, so to speak. Last year, or actually 2018, after a fall of more than 20%, normally increases of 60% follow. Do we think that this could come in 2020, or will it be an exception in this case? I don't believe in exceptions, not in this case, but we don't really know what month, day, and time the fund will increase. It's complicated for me to foresee that, but it's normal, and it will end up happening, but we don't know when. It's been a year since we stated that. There's still one more year to go, so I would be optimistic for this year. Now we're going to shift gears again. Do you think that the new government could decapitalize Bankia to pay off its for its whimsies? Well, hopefully not, because we hold stakes in Bankia and we live in this country, because it would be a very bad signal for the country too. There's many questions about Bankia, actually. Well, when politicians go into power, their goal is to remain in power. So I guess they will try to be the least foolish possible. If you do many silly things, you will not remain in office for very long. So governments that tend to take drastic decisions will end up not really taking them. So we really hope that no drastic decisions are made. Given that our products have timelines that are a bit deviated from indexes, is it logical to continue to talk about a minimum 5-year investment? Could we start talking about a minimum of 7-10 years investment? Well, we must say that in 2012 or 2013, or maybe it was 2014, I don't really recall it. But we were calculating what long-term means. And in a public presentation, we said that we were talking about 9 years. Why did we say 9 years? Because after 9 years, no customer of ours had lost any money. And it was the case that in the previous years, in the year 92, from the year 1992 until 2013, that was a period that we used for calculations. In periods of 9 years, none of our customers had lost money. So investing the way we do requires a lot of patience sometimes, in spite of the fact that in the 25-year period we outperformed the market. But in spite of that, in 8 years' time, some customers had lost money. So if there is no patience, good profitabilities will not be obtained in the long term. So what about timing? Well, the more time, the better. And there's something that is key that we always mention. If you don't need the money, it's clear that you will get to 100, 150, 200. It's clear because assets are there and they're worth it, and there's no doubt about it. But we really don't know when. An investor is asking about the average ROCE for the portfolio, which is based on an estimated profit that you calculate or the current profit. He's asking this because quality funds have this in a very similar position, and they're not precisely cheap. Well, that's our job, finding extraordinary companies such as Share. Well, actually, their competitor is at 30 times profit, and in our case, it was for free. We are not discovering the wheel. We are not discovering the materials that will be used in the future. No, we're just trying to find the materials that are used now below their price. And right now in our portfolio, what we have is the profits that we obtained in 2020, or that we will obtain in 2020, taking into account the circumstances, but this is for this year specifically. I wanted to mention that there could be two companies with a very good ROCE, and if you buy the book value, my ROCE is 30 as an investor of Cobas. But if the company's ROCE 30 in the market and you purchase it at 4 times book value, then the ROCE is 4 times lower for the investors. So that 30 becomes 7. So your ROCE as an investor is not the company's ROCE. As an investor, your ROCE will be 4 times worse because you're buying at an expensive price. Well, with the goal of fulfilling the commitment that we mentioned at the beginning of the conference, which was finishing at 8:30, we are going to start wrapping it up with the last few questions. But before we start doing this, we would like to make 3 remarks. All questions that have not been answered and that you would like to receive an answer for, you can direct them to the investor relations team, and they will be delighted to entertain them. Secondly, after the conference, there will be a survey that we would like you to populate because your feedback really matters to us. So we really encourage you to please fill out the survey. And thirdly, as you exit, you will be able to get an oil bottle that is in a way sponsored by Cobas in Teruel, in an area that requires economic support. Rather than talking about questions, there is a request. They say, please don't be influenced by the current pressures. Please continue to manage as you have in the last 25 years. And please don't try to blow it all up this time. And as I said, their management haven't fallen and they continue to trust you. So there are two questions to follow up on this. The question is, are you reassured? Are you calm? And this is extensive to the whole team. Yes, I have been calm for 1 year and a half. We overcame the problems that we had in 2018, and we have the feeling that we know the situations firsthand. And sometimes, actually, U.S. investors call us up to know what the situation is like, and we have an enormous feeling of control over the cash flows that the companies are going to generate, the revenue that they're going to generate. And this is a very pleasant situation, and I am enjoying myself as I enjoyed myself investing there back in that day, and we are very satisfied with the companies and the assets that we are encountering. So there's nothing much that I should add. I don't know how the rest of the team feels because I'm perhaps a bit older. Well, I need to read this literally because this is a very interesting question. This investor says the following: all of us here know what value investment is, but it seems like we never factor in the competition's profitability in the context of the market. Paco, why shouldn't we sacrifice part of the potential to have an average profitability that is more similar to that of the competition? But we don't charge 175 to create an index. We try and justify this because it's pretty high by finding extraordinary companies at extraordinary prices. I don't think it would make sense. I don't actually understand the question. He's comparing this to other value investors too. Well, we need to invest on the fact. Well, I personally have all my savings invested here, and I think it's the best for your savings in the long term. We don't really need to blow it up. Actually, we just want to obtain a profitability for our funds, and that's what we want. We don't really have an eye on the company, on what on the competition, and what the competition does. I read literally, Paco, after investing with you, investing there for many years, I invested in Cobas from the outset. I'm reassured because I've lived this situation for many years. I have a problem with my sister-in-law. Because she decided to follow me and invest in the selection fund. I've been telling her for 3 years to remain calm, but every time we meet, she really hammers me with this topic. So what can I do? Please help me out because I want to continue to be my brother's brother. Actually, I was telling last year that every single year my youngest son gets $100 for Christmas, and he said that he didn't want to invest in Cobas because then the value would be brought down to zero. It's much more difficult to work with my child than with his sister-in-law because I don't know. You can do the presentation. I don't know. So many people can understand what's happening at the nursing home. Actually, I think I should get in contact with this guy so that we can comfort each other in one way or another because it's very difficult to add more comments on top of what we have already been shared. But there isn't much of a long road ahead of us, and we already talked about the last 2 years, and this year has just started, so we'll see how it progresses. Thank you very much, everybody. One more year. Let's hope that next year we can share this information with a different look on our face. Thank you.